Hey everybody, my name is Chris. I'm here to show you TacBotz. This is a algo signal that me and my friends created to help you guys with your trading. Number one is this is not a replacement for a specific trading style, nor is it going to replace your own risk management plan. So just be sure to have your own style in mind before you start using these. This is meant to enhance your existing style, not to replace it. And also, whenever you're in a trade, don't try to trade these blindly. Definitely take your own risk management plan seriously. So with that being said, let's go ahead and get started. I'm going to show you how to download these signals and also how to read them. So first we're going to go to CHART, so chart.tacbotz.com, so chart.tacbotz.com. That's going to take you to TradingView. And if you don't already have an account, you can go ahead and sign up for one, but I have one, so I'm going to click sign in the menu. So here at the bottom is where you go to sign up, but I'm going to use my usual method for signing in. All right, so once the chart is loaded, number one is we like to use the dark color theme. Light color theme doesn't really show up really well with our signals, so that definitely recommend doing that. And you're going to want to go to the all layouts in the menu, delete the existing one, go back to the menu, save layout. In this case, I'm going to call it TacBotz, TacBotz. You can call it whatever you'd like. Hit save. Once that's saved, we're going to go hop over to the TradingView desktop version. If you don't already have it, click on the menu item. It's the second to last item to get the desktop app. I've already got it, so I'm going to pop on over there. Close that little nag message. Hit that plus button at the top to create a new tab. And you can actually go ahead and close out the old tab. All right, so what you should see is the background that is representative of TacBotz as well as a few signals. One thing I wanted to point out though is in the free version, there's going to be a few limitations compared to those who have the full paid accounts, and I'll try to point that out as we go along what the limitations are. So number one, I'd like to go to a common ticker, so SPY, and I'd also like to go to common time frames, so in this case 5 minutes. So here's one of the ways that I want to point out where there would be a difference. If you don't have a paid account, you're going to have to use whatever you see here in terms of minutes, hours, and days. You're not going to be able to access the seconds or ranges, nor will you be able to set your own custom intervals. So usually you'll see the 5 minute, the 3 minute, and the 1 minute being pretty popular for scalpers, and anything 30 minutes to an hour is good for swing trading. And if you're looking for longer term investment, or if you're looking for signals at the macro level, you'll start to look at the daily or even the monthly and weekly. So let's start with the 5 minutes on SPY. And what you'll see is a few signals out here. I want to describe what they are, but first I want to also talk about why these signals. So why go and create these signals that you've never heard of, and what is the significance? So number one is if you are a day trader and you like to chase momentum, and when there's a high volume for participation, you'll know that those are some of the easiest trades you can make because you can literally see the momentum picking up throughout the day. You know that if you go larger in contract size for options players, or if you take a ton of shares, you're going to be less likely to be chopped out against in your position, and that's why we definitely like it when there's high momentum and high volume. So the signals that we've created for TacBotz is really to help to identify those boundaries. So where is it that we're going to find high volume, high momentum, but identify it before it actually kicks in. So our signals, predominantly the bull tack and the bear tack that you see on the screen here, these are actually indicators of manipulation. So bull tack actually means there's a bull trap that's about to come in. Bear tack means that there's a bear trap that's about to come in. Sometimes these go from bull to bear trap or bear to bull trap. That's actually quite common. The whole point of that is there's market manipulation happening. What you can actually think of is these traps actually help to fund the moves that come in after these signals come in. So when you see these, you know that there's intention for those dynamic traders in the market, those who have the ability to move price. Unlike you and me, we are passive traders. So we pretty much just follow price and try to catch those moves in order to make profits. But for the dynamic traders, they actually have a lot of tools in their toolkit, and one of them is to create bull and bear traps to actually help to collect some of the premiums and the funds that they want to use to actually help to build that momentum up when the market starts to react. So once again, the bull tack signal is a bull trap and the bear tack signal is a bear trap. Does that mean that every time you see a bull tack, it's going to go up and the volume and the momentum is going to follow? Not all the time. And similar for bear tack, does that mean it's always going to go down? No, that's not always the case. However, if the market sees these moves and reacts accordingly, then yes, you might find in a lot of cases some really nice signals where a bull tack led to a nice move up and therefore it faded out near the end of the day. Or similarly, and conversely for bear tack, there was a bear trap that turned into a nice push down to end the day. So those are not 100% of the times, but these are common scenarios that we'll go over in the strategy section later on. But right now, we just want to describe these signals for you. So quickly, if we zoom into the bull tack and just kind of see what is happening, what's going on here, and what do I mean by the bull trap, and how do we use that? So in this case, what you see here is this candle gaps up, and there is actually, in the beginning of the day, there's a pull down. And if you've ever, let's say, been an options scalper, or even somebody who buys a ton of shares in the morning when there's a gap up, you've often felt times where you feel like you've got in a good position, you see some healthy gains on the screen, and all of a sudden the market pulls back. You're thinking about cutting your losses, maybe not adding the size that you wanted to for the full day, or your stop loss just gets triggered and you're out of the play. That's common for these scenarios for the bull tack. As it goes up, it pulls down sharply, and then from there it has to decide where it wants to go. Similarly for the bear tack, it would pull down or gap down first. You might be in a put or a short, and next thing you know, it's being pulled up really sharply without any warning, and suddenly you're in a bad position again. So definitely watch out for that. If you see the bull tack or the bear tack, if you know how to play them, go ahead and trade them as you usually would. But if you're kind of new to trading, I would say it'd probably be better just to observe this behavior and then take some sensible trades after that morning jitter is done. So maybe the first 10 minutes, just observe, and then as you see the play start to unfold, then you can decide what you want to do. So here what you see is the bull tack signal came in, there was a sharp pullback, but it led to a nice move up, and you got some other signals, so we'll go over that in just a second. Similarly, if we go to the bear tack signal, you see a sharp pull down, and then not even the same day, but the next day you get that massive gap down, and then it just keeps moving down. All right, so that's bull tack and bear tack. If you have any questions, come find me in the chat or one of my team members. You'll get to know them over time, and we can happily answer any questions you have, go over the charts with you one-on-one just to make sure you fully understand these. So the other thing that we want to point out is, as a scalper myself, I actually really like to know sometimes when a good exit presents itself so that I don't have to sit in the trade all day looking for where's the top. I can just get out when there's a nice healthy move and actually just be done for the day. So we created these scalp signals. In this case, it's denoted by an S with an arrow. In this case, it's an S with an arrow pointing down, and it's in a blue color. What that means is that there was a heavy price movement in the upwards direction, and for a moment there was a pause, maybe a sharp pullback in price. And to me, that's actually one good exit. So you've got a nice move up followed by a scalp exit is what I like to call it. And that's a good place to take your profits and maybe re-enter if you want more, or actually just sit out for the rest of the day with some nice healthy profits. As you look further down, there's other additional scalp exits, so you can always decide which one you want to take based on your risk profile. We're not here to tell you which one is the best one. We're here to show you all the different ones that we've found mathematically. Another thing to look for is a fade signal. So normally when you see this bull tack signal for this example and you see a nice healthy move, at some point you might see this downward pointing arrow with an F, and there it's a pink color. This is actually representing a fade. Now, does a fade mean that the price is going to reverse, time to get into your puts or go short? No, not at all. What it means is that move that you just saw, that really powerful move up that really helped to raise the price, that might actually be letting up a bit, and that's when that fade signal comes in. So usually what I say is when you're in this long position after a bull tack shows up and you've got your scalp exits, if you're counting your scalp exits, trying to figure out which one you want to exit in, once you see that fade, what you know is you don't have the same momentum on your side. Maybe another surge comes in later and there may be another bull tack to help prove that there is that additional push that's about to happen. But also, you know that sometimes it's just going to go sideways for the rest of the day and you get these marginal highs. So if you're in shares, it may not be a big deal because you don't have to worry about IV crush or time sensitivity for contracts. But if you are in an options position, yes, time decay matters, IV crush matters, and you probably want to be out before the move has lightened up and gone sideways too much. So just keep in mind you've got your signal to say that manipulation has happened. You have a few exits that are based on scalping, and you also have some boundaries where there's a mathematical signal telling you that the momentum has faded and it may not be a great idea to stay in for much longer if you're already in that direction. Another thing that helps you to understand these signals is the background color. So you'll notice here in this current example, there is a green background and it's solid green. So what does that mean? This is actually a trend indicator. So when it's solid green, it means you're in an uptrend, and that's pretty obvious. However, what happens when the color starts changing? So at this point, a really nice example is that in this fade, it goes from green to red. Now this red is a slight pull down, right? But it's a solid red the entire time, which means that that pull down is actually could be a counter trend, but it's a downtrend nonetheless. But what happens when it goes from red to green and then red, green, red, green, red? This is like alternating, right? It's almost like it's barcoding in the background. Well, you probably guessed it. That just means there's consolidation. So when you see that barcoding color, you can look at the price and actually see that it's really just consolidating in a tight range. Sometimes it's chopping up and down, but at the end of the day, we don't have a trend because it's barcoding. All right, and then so once you see that barcoding end, you'll see that there's a nice solid green background, not the best uptrend, but definitely an uptrend nonetheless. And it has a temporary pause with one more red bar, and then it goes back to green to finish the day strong. So overall, what you see is in this chart, you've got a sign of manipulation, a nice move up confirmed by the background being solid green. You have a momentum let up, then you have some consolidation, then you have the final move, and then another fade to close the day. So what this really means is that there was at least two segments of an uptrend. One that starts here, that was the best move of the day. Second one that starts there. And if you look at it, what would have happened if you had stayed in a call or a long position for the rest of the day? Well, starting at 2 p.m., you see that the fade is in, the red background shows up, and now you're pushing down. It's not a really pretty trade to be in if you started anywhere after the beginning. If you, let's say, grabbed it somewhere around this area, you're not looking very good at the end of the day, especially if you're an option. So we try to provide these signals primarily for options players, but we realize that we can help people who do shares, swing trading, small cap, crypto, you name it. There's actually a lot of good use cases for these signals that we were even surprised, given that we're options day traders and we thought this was just for us. We end up realizing with a few of our testers that this can be used in many scenarios. You just got to know how to use them. All right, so that's the example for a bull tack signal. Let's take a look at a bear tack. This one actually is not the best of examples, even though it went sideways. It took a while for it to go down, so I'm going to try to look for a version of this that might just show very obviously what's going on. Okay, so this is a good example, and the reason why I don't want to show you something that just goes down all day is that there are scenarios where you get a bear trap, but it still leads to a reversal, not going down, but actually up. So here in this trading day, we had two bear tacks. What does that mean? The first time it happened, there was a bear trap. The price gapped down. And if you've ever been trading on at 9:30 a.m. Eastern Standard Time and you saw a massive gap down, let's say it was 5% down, you're thinking, wow, this market's going to dump today. You grab that position, what's the next thing that happens? Boom, you get caught in this little reversal. Now, this scalp exit's telling you you've got the bear tack signal, there's a bear trap. When you see that S, it's actually time to get out of your short position. It's just an early warning to say something's about to reverse on you. You probably don't want to sit through this. And the reason is this. Let's say that you opened your contract for, let's say, a short by buying a put right there, and it pulls down, it pulls back up sharply. By the time we get here, I've seen it myself. You could be down negative 50% or worse, and at that point, it's not feeling good. You probably got your stop limits triggered. So it's better to either sit out of this or just respect those scalps and just get out before it gets bad. Because at the end of the day, you can always enter at a better point for that down move. Number one, we've got a red background. And number two, we've got nice price action going down. So why would you want to grab it here and get caught in that bear trap when you can actually just wait for it to have some nice solid moves down before you buy your put or go short? So again, if you look at the fade signals, this fade actually is pointing up, which means that that move down has a temporary pause. Does not mean for the rest of the day it can't go down. It just means that for that moment it kind of paused, and you can see that background change from red to green, so it means you kind of consolidated and went sideways for a bit. So it may be a good idea to get out of your short position at that point, but you can always re-enter when it goes back to red and price action and also red background, right? So then when you get down to this point, you have to think again, do I want to stay through that? Some people do, some people don't. Maybe they're done for the day, so they just get out. But if you do continue to follow, you get 3 fades until you really hit pretty much the bottom of that move. Now, one thing that's very interesting about this bear tack signal, so again, you have a bear trap. Price gets pushed down. There's this scalp exit to say, hey, you might want to get out in case you don't want to get caught in a reversal or a sideways move. In this case, it does go sideways. In fact, at this point, it does dump a little bit, but look at that reversal. That reversal could really punish some contracts if you're still thinking that at this point you're going to go down here. Instead, you're going back up. So definitely think about these signals as potential traps, not just necessarily it's going to go down, but maybe the trap is in there just to actually push the price back up. Again, if you're a dynamic trader, you have all these little tricks in your book on what you can do. And at the end of the day, the more you hurt the market, the more you make free money, which helps you to then add to your existing position, accumulate at a lower point for a move up, or basically play with the market. So you don't want to be caught in these traps. You want to at least understand how to read them. So if you play them, you know when to get out, or just avoid them altogether and wait for the market to pick a direction so you're trading with the trend and not counter trend. All right, and then the last thing we want to show you, except other than the bear tack, bull tack signals, the fades, the scalps, and the background color. So what is this little triangle here? And maybe there's a few better examples. Let me just scroll around to find them. I want to see where those triangles actually cluster up. Yep, there's a few right there. Let's keep going. Eventually, we're going to see some really good examples where there's a ton of triangles clustered together, and that's what we're going to really want to focus on. All right. Okay, so here we go. This is probably a better example because you get some nice side-by-side triangles. They're almost clustered together. So let's just go ahead and look at this area in particular. All right, so what does it mean when you've got these multiple clustered triangles? So pointing up and blue in color means there's a trend in buying. Not so much that there's a spike. You don't want to worry about that top spike because usually that's the end of it. But you want to look at leading up to that highest spike in volume. What is the trend? And in this case, this means that there's increased buying trend. It's a combination of unbalanced volume, money flow index, and a couple of other things that we've mathematically calculated to make sure that we can weed out the noise. So when you see a ton of triangles stacked side by side, what you can expect is that there's going to be a lot of buying pressure. Does it mean that price is going to go up? Not by itself, but what it means is there's a healthy ingredient to help push the price up. Similarly, in this case, you get the same thing here. That was a nice surge up to close the day, and unfortunately for the next day, it didn't carry over. This volume was just good enough for the end of day to push it up, but by the next day, then you see that there's selling volume and it disappears. So anytime you see these triangles pointing up and they're blue, that means there's an increase in trend for buying. When you see that there's these pink ones and they're clustered together, that means the opposite, that there is an increased selling pressure that's building up. And it doesn't mean that's the highest selling volume, it just means that it's trending in the selling direction. All right, so those are all the signals and how to read them. In the next modules, we'll go over actually some examples of uptrends, downtrends, some reversals. How do we play these signals? How do we cater them to different styles? We'll even take a look at small cap versus crypto or large cap, because there's all different types of use cases we can use this for. And we want to try to give as much information up front so that you're comfortable using these. And at the end of the day, if you really don't know or you're really not sure how to use these, definitely look for me. It's TTF Chris in Discord, and you'll notice that there's a few other people who will start to talk about these. Feel free to ask them if they look like they know what they're doing. Hopefully they've gone through this onboarding, or they at least have talked to me personally, and then that way they know what they're doing and they can share that knowledge. So again, this has only been created ever since the middle of September to October is when we actually built this out. So it's a prototype. We are very welcome and open to feedback. Any way we can make this signal better, more reliable, or more understandable, we're definitely open to that. Long-term goal is what we want to do is once we know that this signal is useful, it's helpful, consistent, helps people to increase their win rates, or to at least promote better consistency, getting out of trades before it's too late when there's a reversal. Once we have that information, then we're going to move on to the next step, which is to actually build out an algorithm that will trade off of the best of these signals, not all of them, just the ones that are the most consistent, the most reliable. And what we want to do is to have that algo be available to anybody with a small account. So let's say you're either starting out or you're already a seasoned trader, but you just want to be able to get some house money to help to build your portfolio and maybe try some experiments without using your own money. We do want to be able to start to avail in your own broker, not like in TradingView, but actually sitting in your own account, an API that actually helps you to auto trade, and that way you don't have to be at the computer, you don't have to worry about emotional distractions, and also you have a chance to have some extra money on the side, and that way you could do whatever you want with it, pay some bills, go on a vacation, or just help to fund the next trade that you make with house money. So that's the ultimate goal, is we take this information, we give it to you, you give us feedback, we refine it, and then we ultimately build a bot out of it. But all along the way, we're here to learn. So thank you very much for your time. Really looking forward to talking to you in the chats. And yeah, happy trading.